Yeah, I agree with his take that this should be on people's radar screen. It's definitely a concern, and each day I see more green on the screen, the more worried that there is a bubble. Unless you bought your home in the last couple 3 years, you're sitting on a lot of equity, and there's like zero probability that you would go into foreclosure.
What would be the trigger for more layoffs then, if that were to
Well,
happen? What should investors do in an environment where almost everything seems overbought? Well, we'll talk about that. And what happens with the economy now that the government is in shutdown. According to our next guest, half the country is already not doing great. Mark Zandi joins us. He is a chief economist at Moody's Analytics. Welcome back to the show, Mark. Good to see you as always.
Yeah, thanks, David. Good to be with you.
I want to talk about the economy, economic growth, and start with this article from Fortune that quoted you. Roughly half of U.S. states are effectively in a recession and hang on by their fingertips, says Moody's chief economist. That's you. So 3.8% GDP growth and 4.3% unemployment. Zandi warned that if the economic softness spreads from smaller manufacturing heavy states to giants like California or New York, the national economy could tip into recession. Chief economist told Fortune that 22 states are contracting and many lower middle income households are hanging on by their fingertips. Which are these 22 states? You don't have to list them out, all of them, but what is happening with these 22 states, Mark?
Well, those are states that each have their own kind of story. A lot of it goes back to economic policy. I mean, the Doge cuts are obviously doing damage to DC, Maryland, Virginia, the broader DC market. The nation's manufacturing sector, agriculture, transportation, distribution, mining. Really, the goods producing side of the economy is struggling, and that goes to tariffs and immigration policy. And those states that are heavily dependent or more dependent on those industries or sectors are the ones in recession. I should say 22 states are in recession or close to recession, but those 22 states, many of them are relatively small. They account for about a third of the nation's GDP. Another third is of states that with another third of the nation's GDP is treading water. So like California and New York are kind of neither in recession or expanding strongly. They're kind of treading water. In another set of states accounting for a third of GDP are expanding, growing. Texas, Florida kind of top the list. So it kind of gives you a sense as to the economy. It's not in recession, it's growing, but it's very tenuous because, you got all these parts of the country that are, either in recession or pretty close.
So let me flip this around. What are the other 28 states doing that are avoiding recession and in fact growing in some cases, like you said, Florida and Texas? And second part, are those 28 states the ones that are propping up the markets right now?
Yeah, so Texas and Florida, they are benefiting from just the inflows of people. Their demographics are strong. You got folks coming in from the Northeast, Midwest, from like a Boston and a Chicago coming into Dallas and Orlando, and that helps to support economic activity and growth, and that cuts through lots of everything. It keeps those economies humming. California and New York, that's really about AI. The two artificial intelligence, the boom in investment spending and technology. Those tech companies, those platforms are doing very well. And also the surge in equity prices related to AI is lifting the fortunes of wealthy households, and they're outspending. And of course, California and New York are among the two wealthiest states in the country. So that's helping. So it's really, you've got these, you can think of this dynamic where you've got these headwinds created by the tariffs and the immigration policy and the tailwinds created by AI, and they're bumping up against each other, and depending on your industrial mix, sectoral mix, that determines whether the state is struggling in recession or whether it's kind of hanging firm or expanding.
So can you make the argument or the conclusions Mark, that perhaps some of the states that are in a recession or are close to recession are manufacturing hubs, like you said. They're seeing a slowdown because of tariffs and perhaps a slowdown in trade. And on the other hand, wealthier states like California and New York, those states are being propped up by the wealthier population that are still spending. And because markets are high, the wealth effect is kicking in. The wealthy feel wealthier, so they're spending money. So it's only a small fraction of the population, maybe less than 5%, that's propping up the entire country. Can we make that conclusion?
Well, you got it exactly right, except I'm not sure I'd say the top 5%. It's broader than that.
Okay.
It's probably the top third of the income and wealth distribution. Obviously, most of the action and most of the juice is coming from folks in the tippity top of the income and wealth distribution. But I say that, roughly speaking, about a third of the population that are in terms of income and wealth are the ones that are driving the train here.
Do we need to see a big correction in capital markets before a recession? In other words, due to the wealth effect, do we need to see the wealthier's wealth eroded because of their investments in the capital markets before they start spending less?
Well, that's one way, right? I mean, if we see a correction in the equity market for whatever reason, because valuations are awfully high, and maybe these companies that are enjoying these high stock prices don't live up to expectations, and we see a correction, just a misstep. That would do it. That would cause those high net worth, well-to-do consumers to pull back and be the fodder for recession. But there's other scenarios. For example, this isn't my baseline, but it's a possibility the government shutdown that we're in the middle of now doesn't last a week or two, which is the widespread expectation. It lasts a month or two, and that's a big deal. And that could be enough to cause a negative dynamic to unfold in recession to occur. So there's lots of different ways that could happen, but clearly one scenario that's of concern is, the equity market stumbles here, and that's so key to driving a lot of economic activity.
Just on the government shutdown, I've heard that the government workers would get paid back anyway, so it doesn't really matter. Is that true?
Well, although the president has been threatening not to do that, I mean,
Okay.
it's possible, but it's politically hard to fathom that would actually happen. But under law, they need to be paid retroactively, but that it ultimately has to be appropriated. And if they don't appropriate the money, then they wouldn't get paid. But I'd be very surprised if that were happening. The bigger concern isn't that. The bigger concern is if this drags on for more than a few weeks and lasts a month or two, then government services are severely disrupted. And that's everything from, air traffic to getting, federal flood insurance to be able to buy a home, to the FDA approving manufacturing activity, pharmaceutical activity, SEC approving, doing all the paperwork it needs for an IPO. I mean, it's on and on and on. If the government can't get its work done, then, at some point it becomes a problem for the broader economy.
Let's talk about valuations. Valuations are high. They have been historically high for quite some time, Mark. So I think the question that investors are asking perhaps is, should we even care anymore?
Well, they're high, but they're getting higher, David. I mean,
Right.
yeah, I mean, it's like straight up here. I mean, there's different measures of valuation. My favorite measure is an economy-wide price earnings multiple. Take the Wilshire 5000 in the numerator. That's the value of all publicly traded stocks. Take after-tax corporate earnings in the denominator, economy-wide, from the national income and product accounts. That's an economy-wide PE multiple. You can construct that back to 1960. On average, over that period of history, the PE multiple, I'm making this up, David, I'm rounding, but it's about 10. That's the multiple. The multiple today is 20 on the nose, and the highest it's ever been. The only other time it was even higher than it is today was in the height of the Y2K bubble. That was 24. So, that doesn't high valuations doesn't necessarily mean markets are overvalued or even bordering on bubble-like, but it does feel like the direction of travel is that's the direction of travel, and investors are getting ahead of themselves. That speculation is starting to creep in, and it's not only in the equity market. It's gold prices, it's silver prices, it's crypto. Asset markets, except outside of real estate, financial asset markets are all juiced. And it does feel like we're getting to a place where this, hard to define a bubble, identify a bubble, impossible to know what's going to happen with that bubble. Is it going to burst? When is it going to burst? I don't know, but it does feel like this should be on the radar screen as a reason for some nervousness, some concern.
Phosphate might not sound exciting until you realize it's one of the most critical ingredients in lithium ion phosphate batteries, or LFPs. And as data center, battery storage, robotics, mobility, and EV demand grow, so does the need for phosphate. That's where today's sponsor, First Phosphate, that's ticker symbol PHOS on the CSE, comes in. They're developing North America's only fully integrated supply chain for battery-grade phosphate. Most LFP batteries today depend on Chinese supply chains, but First Phosphate is building a domestic alternative from the ground up, starting with a rare, high-purity phosphate deposit in Quebec. They also signed a deal with one of the leading producers of purified phosphoric acid, giving them a direct path to refine their phosphate for LFP usage. With data center battery storage, robotics, mobility, and EV adoption on the rise and supply chain security in focus, phosphate could become the next battleground in clean energy. And First Phosphate is positioned at the forefront. You can go to the link in the description down below or scan the QR code here to learn more about the company. This was reported by CNBC earlier this week. The bubble and people searching for AI bubble has burst. Retail investors' fear of an AI bubble appears to have fallen off after spiking this summer. I did some verification myself, so I went on Google Trends. I searched AI bubble worldwide. Let's just narrow in on the United States. Let's see what happens.
Cool.
It does seem like, yes, it has peaked earlier in August. Search interest has fallen off a little bit, and I don't know why it's making this projection that's going to go back up. Let's see. But
Anyway,
anyway,
what that is? Is that a projection?
that is a projection. That is a dotted lines is Google making a trend projection based on what, I'm not sure, but they are projecting that the search volume will increase by later October. But it has fallen off since August, so market perception of a bubble has fallen, or at least people have cared slightly less. I guess if you're searching for a bubble, you're concerned about a bubble pop and it hasn't happened, well, time to go back to buying mode,
Well,
right?
is that a good thing, David, or a bad thing? I mean, I
I'll
don't
let
know.
you answer that. Yeah, good question.
I don't know. I mean, the fact that people aren't concerned concerns me more. I mean, if people get complacent, that's when, things they drive up prices even further. Speculation becomes more endemic, and the risk of an actual bubble forming and then bursting is now much higher. So I'm not quite sure I'm whether that's a good thing or bad thing that people are now more comfortable that there isn't a bubble, or they're not searching for the words AI bubble.
Jamie Dimon said there's a 30% of a correction, 30% chance rather of a correction. He says, I'm far more worried than others. This came in this week. So if the market is pricing in 10%, I would say it's more like 30%. And I'm not saying next year because the timing of these things is impossible.
Yeah.
The level of uncertainty should be higher in most people's minds than what I call normal. He's been kind of cautious / bearish for quite some time now.
Right.
I wonder if you agree with this take.
Yeah, I mean, I agree with his take that this should be on people's radar screen. It's definitely a concern. And, each day I see more green on the screen, the more worried that there is a bubble and that it could, or one is forming, and that could become a threat if it were to burst. 30%, that implies probably a false level of precision. I'm not
Yeah,
sure, but
sure.
the level of risk here is high and increasing with each passing day that you see more green on the screen for sure.
Is there a disconnect between the real economy and stock markets right now?
No, I don't. I think so. I mean, I think the bubble, the high valuations is all related to AI. And if you look at the S&P 500 as just your proxy for the overall market, X, the AI companies, there you're seeing stock price gains that are more consistent with the kind of economy that we're experiencing. Not a recession, but one where the economy is kind of punk, not going anywhere fast. It's kind of feels a bit uncomfortable at times, feels okay at other times. So I think what's happening in the equity market is it's just AI and everything else. And when I say AI, it's now AI direct and the platforms and the hyperscalers, but all the indirect kind of activities that are related to AI as well. Everything from electric power to semiconductors and chips and everything else. So I think if you want to really get a read on to answer the question, is the economy consistent with the market? You have to look at the market X AI. That because AI is running on its own dynamic. That's where if there is a bubble, that's where the bubble is forming.
The unemployment rate has ticked up to 4.3%, as you know. Give us a synopsis of the labor market. What is happening right now? Should people be concerned about losing their jobs in the next 2 quarters?
Yeah, this is the weak spot in the economy. This is where the economy is most vulnerable. I mean, job growth has come to a standstill, and I suspect when we get all the data in after revision, it'll show some meaningful job decline. The job growth we are getting is very narrowly focused. It's really in the healthcare, education sector. Outside of that, some industries are adding a little bit, others reducing payrolls. The net is zero. There's no hiring. That's the problem. The hiring rate, the number of hires relative to the labor force, is kind of recession level. It's that low, particularly hard for young people in their 20s if trying to get into the labor market. Their unemployment rate has jumped 3 percentage points over the last couple of years. It's over 9%, and it is headed straight north. Temp jobs are down. It's a leading indicator of weakness. Hours worked are down. They're consistent with recession. The reason why the labor market isn't even in worse shape is that businesses have held the line on layoffs. They're not laying off, which is really key. I mean, I think layoffs are the firewall between the economy we have and a recession. And so far, that firewall is holding, but that's a reason for some concern that there's no hiring and no job growth at this point. So that if you had to point to the thing that is most worrisome, and of course that's what's driving the Federal Reserve to cut interest rates, is that the labor market is very soft.
As an economist, how do you usually approach or interpret a hiring freeze or low hiring? Can you take the glasses half full approach and say, well, maybe the labor market is in equilibrium? Lack of hiring means that everyone is fully employed, and there isn't a lot of labor slack out there for people to hire. Is that one way to look at it?
Yeah, well, I don't think that's the case. I mean, the unemployment rate's up a percentage point from where it was a year ago, and as I mentioned, it's 3 points for folks in their early 20s. And all those other labor market indicators indicate slack, not that the labor market's full up. Now, you could argue because of the immigration policy and the fact that the foreign-born labor force is declining is putting a lid on the ability to generate jobs, no doubt about it. So the break-even rate of job growth is a lot lower. It's probably 50, 75K per month, but we're at zero, probably negative when we get all the numbers in. So I don't think that argument works. It is, you asked a great question. What's fundamentally behind the lack of hiring? I don't think it's one thing. It could be a bunch of stuff. The uncertainty around policy might be playing a role. AI is probably playing a role. There's some research that indicates that that's affecting, particularly for young people, that's having an impact. And it's demand. Tariffs are doing damage to the manufacturing base, to transportation distribution. So, when you have some weakness there, you're not going to hire. So I don't think it's one thing, it's a bunch of stuff, but it's all conspired to indicate that, businesses are just not hiring and the level of hiring is consistent with the recession.
By the way, Jerome Powell himself has called this a low hiring, low firing
Yeah.
situation. When we do get low hiring and low firing, in other words, companies aren't hiring more people, but they're also not laying people off
Yeah.
en masse. What does that mean?
Yeah, I mean, I think it's a vulnerable economy, but not a recession, right? I don't think you get a recession unless businesses lay off workers, but if they do lay off workers, then very quickly we're going under because with those layoffs, that's going to spook low middle income households in particular. They're going to pull back. That's going to cause businesses to lay off even more, and you get into this kind of self-reinforcing vicious cycle called a recession. So that's why I say layoffs are kind of the firewall. The one thing to note, though, about layoffs, at least based on historical experience, is that they happen all of a sudden. One company in each industry decides to lay off workers, then every company in that industry follows suit very rapidly. So it's no layoffs, no layoffs, no layoffs, lots of layoffs. UI claims, unemployment insurance claims go low, 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 boom, you're high. So I don't know. I take a whole lot of solace in that, but the firewall is still up, and I'm not sure I take a whole lot of solace in that, given how quickly things could change and how vulnerable we are.
Right. And so what would be the trigger for more layoffs then if that were to
Well,
happen?
we talked a little bit about that. Suppose the equity market were to correct.
Okay.
Suppose Nvidia. I'm making this entirely up.
Yeah, yeah,
Nvidia
yeah.
it comes in with revenue growth of 96%, but the market expected 103%.
Yeah.
We get a correction. Suppose the president nominates someone for the Fed chair. As you know, Jay Powell, the Fed chair, is going to roll off in May of 26. They nominate somebody that it's not Kevin Hassett, it's not Scott Bessent. It's someone we don't really know. It's someone similar to the BLS commissioner that the president had to withdraw the name because he had no support. That could spook markets. Concerns about Fed independence and future inflation. Suppose the government shutdown doesn't last a week or two, it lasts a month or two. Those are the kinds of things that could happen that could upset already fragile sentiment and confidence and cause businesses start laying off. And again, once that firewall comes down, then we're in recession. We're into that self-reinforcing vicious cycle. But now, let me just say, David, those aren't my that's not my baseline. My baseline is the firewall will hold and we'll get to the other side of this 6, 9, 12 months down the road. We'll get some monetary fiscal stimulus and the economy should regain some traction. We should avoid recession. But, I do think recession risks are awfully high. And these are the kind of scenarios that are behind that concern.
Do you think if companies aren't hiring more and they're not firing more right now, they're probably just, I'm speculating here, maybe they're stocking up on cash, and once we get more policy certainty, if that ever happens next year, that's when we see cash deployment, CapEx spending, and a boom. Is that a plausible theory here?
Well, I mean, they're holding their payrolls constant, right? I mean, so are they preserving cash? I'm not sure. Maybe on the margin, but I don't know that that's what their thought process. Maybe in the sense that they're so uncertain about things, they're sitting on their hands, right? They're not going to move. They're not going to hire. They're not going to fire. They're holding the line on CapEx. I mean, outside of AI, CapEx is has kind of flatlined, back to an earlier point. So broadly, the uncertainty is just causing businesses to freeze, just hold the status quo on every dimension of what they do. And that would explain the lack of hiring and the lack of firing.
What's going on with the labor market? I'll pull up some stats, but let me just to get your overview first.
Yeah.
You did write an article, you co-authored an article from Moody's Analytics called Capital Gains Taxes and the Misallocation of Housing. In this analysis, Moody's Analytics examines how capital gains tax policy is increasingly causing homeowners to remain in homes that are no longer suitable to the demographic needs. That's the first opening introduction. Tell us more about that.
Yeah, so this goes to, one other weak point in the economy is housing, obviously, and the fact that housing demand has been flat on its back. Home sales have been consistent with recession levels, with the actually existing home sales consistent with the lows we experienced during the teeth of the pandemic and in the height of the great global financial crisis. And one of the problems there is so-called housing lock. People are kind of stuck in their homes. There's interest rate lock, where people have mortgages with interest rates that they got back in the pandemic at 3.5%, 4%, and they don't want to sell their home, extinguish that mortgage, go buy another home, get another mortgage, because the market rate is now 6.25%, 6.5%. So that's a form of interest rate lock, housing lock. Another form of housing lock is around capital gains. So, right now there's a capital gains exclusion if you sell your home, but those exclusion limits were set back in 1997. Of course, many years ago, and there's been a significant increase in house prices since then. So many people are sitting on a lot of unrealized gains, and if they sell, they're going to have to pay taxes on those gains. So that is another form of housing lock, another reason why people aren't moving, particularly baby boomers, the folks that are sitting in these large homes that were conducive to their demographic needs back when they had kids, but now their kids are, long gone. They're empty nesters and they have these big homes that they don't need and they don't really want, but again, they don't want to pay the capital gains tax. So they're sitting on it. So the proposal is to simply increase the exclusion so that this is less of a bite if people sell. and that would get help unstick the market, reduce the lock, and get housing transactions moving again, and help the housing market get back on its feet. That's the idea. That's the nature of the problem, and the idea that the policy idea putting forward to try to address it.
Despite this friction, do you think that perhaps lower mortgage rates from lower Fed funds rate going into 2026 may offset some of this friction?
Well, I mean, that's already embedded, right? I mean, markets anticipate the Fed's going to ease pretty aggressively here. So the markets are expecting a 3% funds rate by next spring, early summer. That's kind of the equilibrium rate. That's already priced in. So no, if the Fed actually follows through on what the markets expect, and I think that's an appropriate forecast, then mortgage rates should just continue to stick to roughly where they are, 6.25 to 6.5%.
I'd like to show you some of these stats, perhaps flying under the radar on the mainstream news. This is from Realtor.com. Foreclosures are rising in the U.S. There were a total of 101,000 U.S. properties with foreclosure filings during the third quarter of 2025, up less than 1% from the previous quarter, but up an astounding 17% from a year ago, according to the latest report from Adam Data.
Yeah.
I wonder if you have a reaction to this. What's happening here?
They're coming off incredibly low levels. So even with this increase, they're still incredibly low by historical norms. And it makes sense because most homeowners have a boatload of equity that they built up in their home when house prices took off. I mean, house prices nationwide are up 50, 60% from where they were before the pandemic 5, 6 years ago. So, unless you bought your home in the last couple, 3 years, you're sitting on a lot of equity, and there's like zero probability that you would go into foreclosure. Foreclosures are up. Probably, I didn't see that piece, but I wouldn't be surprised. Maybe FHA loans to homeowners that bought in 2022, 23, or 24, and the prices since then have not really risen all that much. And in some parts of the country, they've actually declined in the South and the West, and that's where you might be seeing the foreclosure issues. But the level, yeah, there you go. The level
You're right. I mean,
low.
if you just compare it to the historical average, it is still quite low.
Still very low. Yeah.
All right, so a slight uptick, no need to worry just yet. We are getting comments that housing affordability is on the consumer side. So take a look at this report, for example. Key findings from the October Mortgage Monitor include, this is the Mortgage Technology Report, ICE Mortgage Monitor. Falling rates lead to best home buying affordability in 2.5 years, with 30-year mortgage rates averaging 6.26% in mid-September. The monthly principal and interest payment on average priced homes has fallen to $2,148, or 30% of the median U.S. household income. Still more than 5 percentage points above its long-run average. Although costs have declined, it's improved from 35% peak in late 2023. Yeah. So a slight improvement in affordability from a rates and mortgage expenses perspective. What does this mean for buying into 2026, you think?
Yeah, I think we're going to see a slow, steady improvement in home sales as affordability, while still really poor, is improving, and we should see some more transactions. The other thing that's happening is that people have been locked into their homes for a long time, and their demographic situations have changed over the past 5, 6 years, and they're sitting in homes that don't fit their demographic need. And at some point, given the demographics, despite affordability, they're gonna want to sell, they're going to need to sell, and they will sell. We're going to get more inventory. So home sales, housing demand is flat on its back, but it's not going to get any worse. And I expect it to steadily get better, and in part because of that improvement in affordability, which goes to mortgage rates primarily. Mortgage rates have come in. I mean, back in 2023, when the affordability was at its low, fixed mortgage rates were firmly over 7%. They're now, 6.25, 6.5. And so you've seen some improvement, and with that improvement, you're seeing some improvement in demand, and that should continue.
All right. Well, final question. Selective job market disruption. You were on a podcast with Capital Group's Jared Franz recently, and I believe you were talking about a lot of the topics we're talking about. So let's finish up with the job market. You are not calling for mass unemployment just yet, but you are saying that some sectors will be disrupted more than others, if I'm not mistaken. Can you just comment on that? Which sectors will do better than others in the remainder of the year and into next year?
I think we, in that conversation, we were talking about AI, weren't we? Artificial intelligence, what disruption that create. And I think the point, at least the point I was trying to make, and I think Jared was making the same point, roughly speaking, is AI is going to be disruptive for certain occupations and certain industries, and we're already starting to see it. But yeah, in terms of overall employment and unemployment, it won't be overly disruptive. Won't There's a lot of concern in the tech world that this is going to be dystopic. The AI is going to come on so fast, cause so many jobs to be lost that there's going to be very high unemployment, even mass unemployment. Uh, we have to be humble here because there's a lot of unknowns and this is a new technology. But if
Yeah.
history is any guide, that's not what's going to happen. What's going to happen is AI is going to diffuse through the economy slowly enough so that it allows the economy to adjust. And we will see some dislocation, some unemployment, but it'll be very modest going forward.
Perhaps not in the long run. This is a medium-term forecast. But let's put on our sci-fi hats here now, Mark.
Okay.
Looking ahead multiple decades, I can't. And some economists have been, even some scientists have been, kind of warning about the scenario in which it's a scenario in which AI basically outperforms everybody at everything. We're going to have humanoid robots performing blue-collar tasks more efficiently and perhaps more safely. Perhaps a robot plumber. I think AI could do my job better. Imagine a podcaster hooked up to the internet. Perhaps an AI economist could look at multiple data points across
Never.
billions of different data. No, never. You're never going to get replaced, Mark. Never. I'm just saying, in a world where a lot of people will get replaced, what do humans do? I mean, how do you even, as an economist, look at the labor market? You have to fundamentally change your definition of what full unemployment means or structural unemployment. Some economists are calling this more disruptive than the internet, but that's their opinion. What do you think?
Yeah, I mean, if again, an economist that does forecasts, I look to history as a guide to help with those forecasts. I look for historical analogs, and if I go back and look at other periods of rapid technological change, it just takes time for that to diffuse. And then generally, the technology doesn't diffuse until new companies form and optimize around that new technology. That takes time. And there's so many other frictions involved with the diffusion, legal issues, compliance issues, financial constraints, so maybe this time is different, but I doubt it. I think AI is going to diffuse in a way that will allow for the economy to adjust and for the labor markets to digest it. And again, I'm not saying there won't be job loss and a lot of churn in the labor market, but the net of all of it will be a labor market that's just fine. And the labor market can adjust in a lot of different ways. It's not written in stone anywhere that people have to work 40, 50, 60 hours a week. They could work 10, 20, 30 hours a week. I mean, so there's lots of ways of adjusting, to these kinds of things.
There was a period of time when I think more than half of the labor force was involved with agriculture, and then post-industrial revolution, people have more time to pursue other professions and leisures. And what would happen to the world when 20 hours a week is all that's necessary to maintain full productivity? I don't know.
I'm not worried about it, David. We'll figure it out. There's going to be things that we're going to be able to do that we can't even envisage at this point in time. Yeah, so I'm not worried about it.
A lot of free time for us all.
Well, no. I mean, we'll fill it. We have no problem filling it. So I'm not.
Okay.
I'm not in the slightest bit worried about that.
Thank you. Where can we learn about you, follow you right now, Mark?
Yeah, there's my podcast, Inside Economics. I would encourage people. You got to be a little nerdy, but if you're listening to you, David, you're nerdy, so you'll enjoy my Inside Economics podcast. And I'm on social media, and of course, Economic View is our website that you can go to if you want to see real time what's going on in economies around the world.
All right, we'll put the website down below, as well as Inside Economics podcast. Check it out. Thank you very much, Mark. Good to see you again. Take care for now.
Anytime, David. Thank you so much.
Thank you for watching. Don't forget to like and subscribe.